of at least the high of the discount fair value gap, which would have been, and again, I shaded mine blue. And now there's some of you are pissed off right now thinking, man, I don't know what he's doing. It's all in the very thing I'm talking about. It's in the recording. I'm recording this. It'll be there. You just play it and do exactly what I'm doing and telling you what I'm doing with your chart. This is interactive. That way you'll see it on your chart. And when you see it and you annotate it, it's all you. It's your information, your annotations. You see it. I'm not pointing to it. You're drawing your own analysis and your own perspective from what it is I'm talking about in the chart. But you'll see exactly what I'm referring to. So think about it like overbought, oversold. Okay. Between these two fair value gaps, because I'm not interested in going long in ES. I wasn't interested in going long ES this week. I was only interested in going long in NQ. So NASDAQ was my choice for upside. And I said that ES was weaker than NQ. That was your tip off. Okay. If shorts are forming, you want to be focusing on shorting ES and not so much on NASDAQ. Look at the fair value gap that formed on Thursday at May 11th at 6 a.m. on your hourly chart for ESM2023. We roll back up into that at 8 o'clock in the morning. So that market report that came out at 8:30, that's what it's showing you, that price delivery went up, went a little bit above the low of the 5 a.m. candle, and then gave up the ghost and traded all the way down to 41.22, which is an old new week opening gap. I'll let you do your own analysis and study and find out which one that is. Oh, ICT. You're really getting bad at this teaching. I never claimed to be the best teacher. And then the market traded again lower, went below the low formed on Thursday at 10 a.m. on Friday, making the low at 2 p.m. and then repricing back to an old new week opening gap low at 41.36 and the high of that discount daily fair value gap. So shorts only were the best moves for ES, in my opinion. Longs were better served on NQ. Go back to your NASDAQ chart. By having an expectation, anticipating price delivery to the upside on that weekly chart for ES, that gap, remember the levels at 13,480.75 and the low of that gap being 13,453 even. That was the draw on liquidity. The market wants to reach up to there, and it did so. There was nothing really clear with ES showing no willingness to want to go higher with NQ. So it's telling you it's being held. It's in a holding pattern. That means it's being manipulated heavily, not being permitted to trade higher. But what market was telling you it could go higher? NQ. So therefore, if NQ is the higher reaching market that wants to go higher, it's being given clearance to trade higher because it's giving you signatures by saying, okay, on the 10th, it didn't make that lower low when ES and Dow did. So it's showing you, okay, there's SMT. And now does it want to make higher highs and do down close candles find support? Yes. So it's telling you order flow is bullish. So what do you reach for? Higher time frame objective. Where's the draw on liquidity? The weekly chart, that gap. What did your chart print? That gap. So when we're looking at price action, it's not just simply go out there and say, okay, well, ICT trades NQ. I'm going to trade the ES because that's going to be my model. That might be true sometimes, but you'll also get frustrated when it's a market like we in this past week where we had manipulation. Think of it like this. For Forex trading, when the dollar index is being held in consolidation, Forex pairs that are not coupled with a dollar will have extrapolated price moves. So you have to do a lot of you have to do one step more in your analysis to trade those pairs. I call them exotics. Dollar-based crosses, they're just the standards. So anything apart from a dollar-based Forex pair to me is an exotic. So if you're trying to trade those exotic pairs in Forex, you're better suited when the dollar index is not poised to move directionally. So if it's being held in consolidation, that's a green light go. And I've taught this in core content, by the way, in case you haven't got to that point yet. I go into great detail about it. But there's cross-pair manipulation that occurs in Forex that if you don't have the understanding about what it is that the dollar is telling you, if the dollar is being held in consolidation, you don't want to be trading euro dollar. You don't want to be trading pound dollar. You don't want to be trading Aussie dollar or New Zealand dollar or dollar yen or dollar Swissy. You don't want to be trading those pairs. You want to be trading the strongest performing currency. What would that look like? Well, what NASDAQ was showing here. Willingness to go higher when others aren't. Willing to make a lower low when others are making lower lows? No, it's going to repel and not say, I'm going to go lower like you. So that's telling you it's strong. Now, if you couple that with a currency that is showing easy price delivery, going making lower lows and failing to make higher highs, or here's one more advanced version of it, fair value gaps not getting filled or even retraded back up into. That's an exceedingly weak market. So if you compare and look for strong Forex currencies, not pairs, currencies individually, that are going higher or showing relative strength versus a currency pair that's weak, then between those two currency pairs, you find the exotic that makes that pair. And if it's the stronger being listed in the name of the currency pair first, then you want to be buying that exotic. And you're going to have a very handsome price run while the dollar goes nowhere. Mic drop. That's the shit that you don't learn in books, okay? That's the stuff that when you get with somebody that knows what's going on and how to read price and not just simply look at price action, you have to know the lay of the land. You have to know the environment you're trading, the market profile, the schematic that the market itself is under. You have no idea. These yahoos out there are talking about they're masters. They're price action masters. Okay, the fuck your master this. You ain't got any clue what you're doing. You have just a sprinkling of everybody else's shit, mostly mine, and you don't even know it. There's a difference between knowing and being familiar with. There's a difference between explaining something after it's happened, but not being able to do it in detail and call it out in detail what it should be doing. I gave you go back to NQ. So NQ M2023, and let's go to a 5-minute chart. So just type a 5 and hit enter, and you'll drop into. All right, and if you recall back on actually, I think I miscalled the time frame. Look at Wednesday, May 10th, on a 15-minute time frame for NQM2023. So we're looking at NASDAQ June contract. And again, for TradingView, the symbol you would type in would be NQM2023. And you want to put it on a 15-minute candlestick chart. And you want to take your cursor and move it over and hover over top of Wednesday, May 10th, 2023. And it's the 2:30 p.m. New York local time candle. That's a buy side and balance, sell side and efficiency, fair value gap. You see that? Draw a rectangle on that and draw it to the right. You'll see that we drop down into that on the 10:30 a.m. Thursday, May 11th, 2023. We have a little bit of a mohawk where we just go down just outside of that low, the fair value gap, just a little bit. That allows the algorithm to provide the liquidity for anybody that wants that low with a fair value gap. So to get that low booked on a short cover or to go long, that needs to offer what? At least one tick difference. So it has to go just outside the line. Okay. So we're not discouraged when price moves just a little bit outside of what we're looking for. It's still precise. And a mohawk is my way of this explaining how the market can sometimes color outside the line. In Forex, I've built in all my concepts with 3 to 5 pips of variance. And that's why I tell you, the folks that always claim they got 1 pip and 2 pip stop losses and they can do it all the time, and they always do it like that. I always say, that's bullshit, because your broker, because I'm going to tell you right now, if I ran a brokerage, I would do that shit. I would clean the floors with everybody that had that kind of shit. But they put their stop loss where I can expand that spread just a little bit more and get it, and I would trade against them. I would book everybody. And this is the way it is. Because your broker's telling you they're doing it anyway when you sign up. You never read those fucking applications. You never read them. You know you didn't. You don't read them, just like when you open up a bank account. You're saying, here's my money, and I agree to the rules that says that you'll give it back to me if you feel like giving it back, or if the market provides you the means to do so. Until then, the money's technically legally yours. You don't read that, but that's exactly what you just signed up. You just signed up for that shit every single time. So we have to make certain allowances for price action. But there's not 3 or 5 handles of variance in Forex. I'm sorry, in futures trading, is it? Very small, up to 1 full point, which is 4 ticks. That's about enough for me. Anything more than that, I'm probably way off in my analysis. But you'll see that within 4 ticks, generally the things I'm teaching you are going to book. And 1 point slippage, we'll call it that, in terms of accuracy, I think that's astounding. I've never seen anybody else that have anything conceptually that allows for that, just that small portion. And I don't even need that much. I mean, look at the things I show you. Like, it's usually right to the tick. But I allow for my own analysis. I allow for 4 ticks variance when I'm trading index futures. So in my analysis, in my stops, and all these types of things, I allow and I build in that fluff that could allow for just a little bit of coloring outside the lines, where it would otherwise scare other people. Like, at some point, if people were looking at this as a student of mine and he had that fair value gap noted from May 10th on the 15-minute chart at 2:30, that had extended out, and the candle forming on 10:30 on Thursday, when it was bold-faced bearish and it was below that, I'm sure they were probably sweating, thinking, man, is this thing going to go? Is this going to keep going? Is it going to keep dropping? No. It's allowing for that delivery to get the very low of the fair value gap. And then the market does what? It closes at the high of the fair value gap on that 10:30 a.m. And then it opens right at that fair value gap high and then runs away up to the upside, drops back down into the order block that formed at 10:30, and then rallies higher, back up into consequent encroachment of the weekly gap, that real liquidity void at 13,466.75, and then subsequently finds some support at the low of the gap on 8 p.m. Thursday, and then rallies to fill that weekly gap. So you have price delivery that you can go back and back test. You can look at all these things and how they repeat. But I gave you a short on ES, and it was a fair value gap down into a liquidity pool. And you saw me execute, obviously, on that. And then later in the day, so I got to go to ES now. So ESM 2023. I gotta find my areas. I gotta find my annotations because I have them set to only show on 5-minute chart. So I gave you the fair value gap on Wednesday to look at, and then the 41.27 liquidity. I'm trying to find a way to say this so that way it doesn't sound like I'm a discouragement to you. So allow me a moment to kind of like put this in a way where it's not so pointed. I don't feel comfortable when you show me trades that you've taken on days that I have already warned you about in terms of the risk. When I don't like or heart your tweet, don't think that I didn't see it. I see every tweet. Every single tweet that comes to me, either I don't agree with, or if I agree with, or if I find it's noteworthy or whatever, or I share in that sympathy, I'll retweet it. I don't heart your trade results because I don't want to encourage you to do something in a time when I don't know where you are in your learning. Like, I don't know how long you've been studying. I don't know if you've ever made money. I don't know, but I don't know anything about every one of you. So when I'm wearing the hat of a mentor and you're showing me your trades, whether they're profitable or wildly even profitable. Um, for instance, I saw a few people say, I just passed my funded challenge with that trade that I shared the other day with the silver bullet trade. And I knew sending that out, everybody that would ever take my trades did it that day. And I'm not trying to be an oracle. Okay. A lot of you call me Neo or Morpheus, and a lot of you want me to evolve to the oracle. Okay. Where you just come to me and I'm going to tell you what's going to happen. Okay. I don't want to be that. I'm not Neo. I'm not Morpheus. I'm IC fucking T. And I'm not trying to be anything apart from that. And I get anxiety when I see students taking risks in environments where I'm explaining to you that it's elevated risk. And in other instances, in other circumstances where we aren't in those types of climates, I would be high fiving you saying, yes, that's awesome. I'm proud of you. But I'm trying to be very cognizant to the influence I have as an educator. I don't want to influence you into thinking good behavior with limited understanding. And that means it's reckless then. Okay. Things that would otherwise be done in other market environments with more insight, more experience, that's what you're aiming for. But when I tell you we're in a high risk environment, we're in a different kind of climate right now, and you're new, and you do something and you get a result that's positive, or you make money, or if your demo account does well, or if you get a funded account, or it makes some money transaction that allows you to get a payout based on that trade that I shared. Admittedly, I want you to understand how it makes me feel. Anyone else out there would be championing that and walking around like a pony show saying, see what I did, see what I did, see what I did. I gave this guy this, I gave this gal that, they made this, they made that. I'm telling you, as the human being, me, okay, I get really uncomfortable with that. And as much as I want to share in your success, I do, I absolutely want to do that. It makes me want to withdraw and not do what I'm doing by calling out moves like that. I don't want it. So